Hi, everybody. How are you guys doing today? I heard you guys say that there's no sound. So, guys, just so we all know, I have to start for there to be sound. So, pretty much, if you don't see anything on the screen, you're not going to hear any sound either. So, we're getting ready to start today, and we are going to go over finance. Boo. Ugh. Finance is such yuck. Okay, but when we talk about finance, there's certain words you guys have to know. One is the difference between primary mortgage market and secondary mortgage market. Welcome, Mimi. I'm excited to have you. What is the difference between the primary mortgage market and the secondary mortgage market? So before we do any questions, I want us to go over some basic things that we all should know. So primary mortgage market and secondary mortgage market, what's the difference? So the primary mortgage market, if you guys don't know, is just when you go to the bank, you get a loan. You go into Wells Fargo, Chase, whichever one you use. You go get a loan. Okay? The secondary market is when they buy those loans and resell them. Why do they resell those loans? Why do they do that? So we learned when we study secondary market, resale, marketplace, right, guys? We all learned those key words, secondary market, resale, marketplace, okay? But why? And I say this because I believe if you guys understand the point of all this, you'll have a much better chance of passing. Because some of you guys, I believe, and correct me if I'm wrong, get in this habit of just memorizing words. And that's great to do, but part of the problem with that is if you don't get those exact words in your exam, you could have trouble. But if you understand the whole concept, then you don't need the exact words in order to get the question right. So the reason the secondary market exists is to free up money so more people can make loans. Because if there's no secondary market, then the bank would have to be like, we could give you a loan, but could you wait like 30 years, please? The term of a loan. They would run out of money to lend out. Okay? Does that make sense for everybody? Right? That makes sense. Okay, so that's the difference in the primary market and the secondary market. Okay. Let's do a question that's on the board. A lender that invests a major portion of its assets in long-term real estate loans prefers large loans on commercial properties and does not like it to services its own loans is A, commercial bank, B, savings and loan association, C, credit union, or D, life insurance company. And I saw that question. Somebody said, who buys those secondary mortgage markets? Those big players in Wall Street. You could invest in it. If you get a financial planner, they could help you invest in things for people who buy things on that secondary market. There's a lot of different ways to invest in real estate beyond just buying a home and renting it out. Some of you guys have learned about a real estate investment trust. If you guys learned about that, it's in some of your textbooks. But there's a lot of ways, if you guys look beyond just the obvious of what's in front of you, of how to invest in real estate. Okay, as for the question on the board, the answer is insurance companies. They do these massive loans. Insurance companies do. They have these big long-term benefit. When you guys are given money, when you borrow money, okay, are you guys the mortgagor or the mortgagee? So you are receiving money. Are you the mortgagor or mortgagee? So when you get a loan and you borrow money, so the bank's giving you money, are you the mortgagor or are you the mortgagee? What do you guys think? So you, the person who's borrowing money, are you the mortgagor or mortgagee? It looks like you guys are split on that one. So I'd like to see in the chat, some of you try and justify your answer before I tell you the correct answer to that. So why are you the mortgagor? So Hillary Rogers was the first one to give an explanation. She wrote, because you're the one giving them the title. Good job, Hillary. Okay, so the answer is you're the mortgagor. Okay? Because before you receive any money, you got to give them that promissory note, that evidence of the debt. So the bank is going to receive that promissory note, making them the mortgagee. Everybody understand that OREE rule. We all learn it. OR, give or less or vend or proprietor. That OR means they're giving and EE receives. People often get this one confused and think, oh, the mortgagor is receiving money. Or excuse me, the one getting a loan is receiving money, therefore they're the mortgagee. The borrower is the mortgagee because they're receiving money. But if you say that, you don't really understand what the word mortgage means. What does the word mortgage actually mean? Who knows what it means? What is the literal translation? So it's not an exception. Be careful of that one, Tatachem. I think I read that right. If you understand it, it's not an exception. If you understand what it is that's being given. Okay, so the actual word mortgage, this is a great conversation next time you're with family over Christmas, is death pledge. Nice job, Jessica Black. I'd give you a big fist bump if I was with you. It actually literally means death pledge. It doesn't have to do with money. So the mortgagor is giving that pledge. Does that make sense, everybody? That mortgagor is giving that pledge because the word mortgage literally means death pledge. Okay? So you're giving that pledge. And the one receiving that pledge would be the bank. And then later comes the money stuff. And that's why it's not an exception to the rule if you understand what the word mortgage literally means. Does that help? Hopefully that helps. And if you guys go to class and like it's an exception to the rule, you can raise your hand and be like, it's not an exception, it's a suffix, and I understand what the word mortgage means, so it's not an exception. Okay. Sorry that explanation was a little long-winded, but I thought it might be helpful. Okay, let's do the next question. When the term beneficiary statement is used by one of those in real estate finance, it identifies a statement made, A, by the insurer stating an amount that will be paid to the policyholder if the improvements are destroyed. B, designating the one who will receive the property in the event of the borrower's death. Or C, by the property owner listing the beneficial features of an assumable loan. Or D, by the lender as the current balance due to pay off a real estate loan. What do you guys think? The answer is D, by the lender as to the current balance due to pay off a real estate loan. You guys excited to start selling real estate? Start making money? You guys will pass before you know it and have mega bucks in your bank. Okay, next question. A fixed rate home loan that is fully amortized according to the original payment schedule. A, permits the borrower to pay the same amount each payment period. B, cannot be sold in the secondary market. C, requires a monthly payment amount that fluctuates each month. Or D, has an interest rate that fluctuates based on an economic index. Team Titus, I know you will pass. I feel it. I'm throwing positive energy in your face. Positive energy. Go get them. Okay, and the answer is A, permits the borrower to pay the same amount each period. Okay, so we're talking about amortization. What is amortization? Welcome, Ophelia Ortiz. Thank you for coming. Glad to have you. So what is amortization? Who could define that for me? It's an important word of finance we all should know. That positive energy blew your hair back, right, Team Titus? You're like, woof, turn the air conditioning down. That came strong. Okay, so amortization is the process of paying off a debt, right? Your debt's decreasing. What would be a fully amortized loan? What would that mean to you guys? What would be the fully amortized loan? What do you guys think? A fully amortized loan. A fully amortized loan is one is fully paid off. Okay, so that's a fully amortized loan. What is a straight note? What is a straight note? What is a straight note? What do you guys think? So straight note is when you only pay the interest and your debt stays the same. What is negative amortization? Negative amortization. Negative amortization is when you pay off the amount every month, but your debt goes up. Okay. When a property is appraised as part of the loan application process, a copy of the appraisal, A, is given to the seller upon written request, B, must be provided to the borrower, C, must be shared with all other parties, or D, it's confidential and for the lender's use only. What do you guys think? And the answer is B, must be provided to the borrower. If you guys start your Instagram profile, start gaining followers, you guys start doing that, building your sphere of influence before you pass your exam. But be careful with Instagram, obviously, because you start following other real estate agents and you see their best selves. And sometimes everybody thinks, oh, everybody makes so much money. But you always got to remember that people are always posting their best news. They don't post the struggle. I guess that's true for everybody with Instagram, right? People always post their best moments. Hillary Rogers says, there's someone good that talks about real estate marketing. Yeah, he's got blue eyes and wears a hat and has a big YouTube channel. I believe that hat's a fedora. And he also helps people pass the exam. And he's got 2 thumbs and talking to you right now. Okay, move right along. When the deed in which you take title to the property contains the following clause subject to the existing loan, A, you agreed to assume the loan and make the payments directly to the lender. B, the seller is permanently relieved of the liability. C, the lender is guaranteed that you alone will pay off the loan. Or D, you are in danger of losing the property if the seller does not make the payments on the underlying loan. The answer is D, you are in danger of losing the property if the seller does not make the payments on the underlying loan. So you got subject to and assume. So when we talk about finance and we hear this word assume and subject to. So everybody write this down for me. Just write this down. This will help you pass. Assume, buyer liable, subject to, seller liable. And I'll say that again. Assume, buyer liable, subject to, seller liable. So write that down. Assume, buyer liable, subject to, seller liable. Okay, those are some key words that will help you pass that real estate exam. You guys should know. Okay. And what that means is when the loan is assumable, the buyer takes over responsibility. You see it with certain types of loans, and certain loans don't allow it. Subject to, which is more typical, means when the loan is sold, the seller has to take care of that debt. Okay, when purchasing with FHA financing, a new buyer would normally do each of the following except A, apply directly to a bank or savings loan. B, pay off mortgage insurance protection. C, apply to a local FHA office for the FHA appraisal. Or D, buy a home which conforms with the FHA requirements and restrictions. What do you guys think? And the answer is C, apply to a local FHA office for the appraisal. All right, you would not do that. Okay, FHA is insurance for the lenders. They don't actually make loans. Does everybody get that? So FHA, when people get an FHA loan, all right, they're not actually getting a loan from the FHA. When you get an FHA loan, that means you're getting a loan that is insured by the FHA. Does everybody got that? Okay. Do you need a down payment for an FHA loan? Do you need a down payment for an FHA loan? Yes, you do. Do you need a down payment for a VA loan? Do you need a down payment for a VA loan? Do you need a down payment for a VA loan? And the answer is no, you do not. Can you buy a commercial property with a VA loan? Can you buy a commercial property with a VA loan? No, it's meant for your residence. A buyer wants to take out an FHA loan. The broker should refer the buyer directly to A, the Federal Housing Administration, B, any approved lending institution, such as a bank or savings and loan association, C, an FHA appraiser in the area, or D, the Federal National Mortgage Association. I'm sorry, Bernie, did I miss your question? You could ask it again, and always you could post it in our group. Guys, don't forget that we have our group on Facebook, okay? It's the Real Estate Exam Study Group. Just look up PrepAgent Real Estate Exam on Facebook. You see our group. I think it's up to 16,000 people now. It's kind of crazy. Lots of people. So if we don't answer your question, you could post it there, and somebody there will answer it. And obviously, I'm going to try to be more diligent to jump in on that group and answer people there. Because I prefer answering people there because then everybody could see my answer and Adrian's answer. I already did this one. When the real estate market changed from buyer's market to a seller's market, which of the following results could naturally be expected? So we asked what a VA loan is. VA loan is a loan program to benefit veterans to make housing more affordable for them for their personal residence. That's what it is. Okay, so when the real estate market changes from buyer's market to seller's market, which of the following results could naturally be expected? A, prices would probably drop because of the increased supply and reduced demand. B, prices would be unaffected since every parcel is unique. C, prices would rise because of the increased demand and lagging supply. Or D, construction activity in a new subdivision would decline. And the answer is C, price would rise because of the increased demand and lagging supply. By the way, my apologies for the webinar yesterday. For you guys who were there, we had a little snafu, but as you can see, we got everything squared away. And we're back on track. I think that was like the first time that's happened in 2 years. Ruby says, Joe, any tips for a nation test for studying? Courage, Ruby, courage. Just believe and hear my voice on your shoulder like Obi-Wan Kenobi to Luke Skywalker. I guess I know I'm kind of kidding, but I guess the real thing is for people who want tips, and here's the truth, guys, I don't have any magic formulas. It just is what it is. Everything I know I put out there in these webinars and all the materials we do. I can promise you guys there's nothing in my back pocket that I'm like hiding only for like special people because you're all special to me. So everything I got, we put out in these webinars, everything I know, all the information I could give you to try and help you pass. There's just no secret formulas. It's just consistency and following a process and not waiting till the last minute. Okay, which of the following is true of a second mortgage? A, it is usually issued at a higher rate of interest. B, it cannot be used as a security instrument. C, it has priority over a first mortgage. D, it is not negotiable. Okay, the answer is A, it is usually issued at a higher rate of interest. When a lender speaks of discounting, the lender is probably referring to A, the loan proceeds dispersed by the lender are less than the face value of the note. B, the process of determining the actual yield given by adjusting the variable interest rate. C, the process of determining the effective interest rate. Or D, the difference between the nominal interest rate and the effective interest rate on a specific loan. Can I explain a security instrument? A security instrument is anything that just gives collateral or ensures that the loan's going to go through. So they could be documents, they could be things you're putting up as collateral, things of that nature. Okay, and the answer is A. The loan proceeds dispersed by the lender are less than the face value of the note. So when you pay discount points, it's a way of paying down the loan in advance to make it cheaper over the long term. This is a tough one, I agree. Mortgage bankers typically, A, do not finance construction loans. B, are the ultimate lenders in most non-government loan transactions. Or C, will not act without the consent of the principal. Or D, originate a large number of loan transactions and then sell mortgages at a discount to large investors in the secondary market. What do you guys think? The answer is D. Originate a large number of loan transactions and sell these on the secondary market to large investors. Okay, I want everybody to write this down. Okay, everybody ready to write something down? Okay, write ready if you're ready. What I'd like you to write is in-term loan, short-term loan, in-term loan, short-term loan. Write it down. I want to see it in the chat. In-term loan. I want to see all this in the chat. In-term loan, short-term loan, takeout loan, long-term loan, takeout loan, long-term loan. Joe, awesome. No, don't write that last part down. But do write the other parts. Right, in-term loans or short-term loan, and that's a construction loan, so I thought of that, but these are more key words that you guys have to know for your exam, and that's typically construction loans. Takeout loan is that long-term loan. Oh, how many of you guys actually started to write Joe is awesome? Just started that mindset, just writing. Okay, so the takeout loan is that long-term loan. The in-term loan is that short-term loan. Super important you guys know that. A buyer is most likely to borrow the money to buy his or her home from A, secondary mortgage market, B, a credit union, C, investment group, or D, relatives. A buyer is most likely to borrow the money to buy his or her home from A, a secondary market company, B, a credit union, C, investment group, or D, relatives. What do you guys think? And the answer is B, credit union. If any of you guys circled D, relatives, I do not want to be at your Christmas party. Has any of you ever borrowed money from family or lent money to family? How often does that turn out well? My rule, if I lend money to people, I just assume it's not coming back. Okay. With certain restrictions, the federal tax law permits deductions for mortgage interest on which of the following property types? A, primary residence, a second home, or rental property. B, primary residence, second homes, commercial rental property. C, primary residence, second home, residential rental property. Or D, primary residence, second homes, or industrial rental property. What do you guys think? And the answer is A, primary residence, second homes, and rental property. A standard for expressing the true annual cost of borrowing expressed as the A, Regulation Z, B, APR, C, ECOA, or D, RESPA. What do you guys think? And the answer is B, APR. APR is formed to make the loan amount very comprehensible, so it's not complicated. Otherwise, it'll look like you're paying the "we screwed you" tax, the "ha-ha" fee, the "you're a sucker" charge, the "we got you" fee, and all those. Instead, they just have a big APR, which kind of puts all the numbers together, so it's not like these big confusing numbers that don't mean anything. Value placed upon property for property tax purposes by the tax assessor is known as A, estimated value, B, actual value, C, appraised value, or D, assessed value. What do you guys think? Value placed upon property for the property of tax purposes and tax assessor is known as D, assessed value. Good. All right, guys, that's it for today. Tomorrow I'll be here at 9 o'clock California time, 12 o'clock East Coast time, and you do the math wherever you are in between. Thanks, everybody, and I hope you have a great evening. Next week is Christmas week, so I don't know about if we're going to be doing webinars next week. So if we're not doing a webinar, you want to see one, don't forget you guys have access to all the recorded webinars through your control panel, okay? But next week, we're probably going to take a little time off. So I'm not sure how many webinars we'll be doing, if any at all. Okay, but do remember, if you still want to watch a webinar, we have all those recorded. All right, so have a great evening, guys. Thanks. See you tomorrow.